Hi, Todd Engelhardt, Regional Director of Investments, Cumberland Advisors, standing in for Matt McAleer. It is Friday, July the 30th, shortly before the close. It's been a bumpy week on Wall Street. It appears as though the major averages are all going to finish in the red. At present, the S&P 500 and the Dow are off by about 0.4% on the week, and the NASDAQ 100 is off by about a full percentage point. It was a huge earnings week. A number of big companies reported: Apple, Facebook, Google, Microsoft, a host of others. Overall, a very, very impressive showing. Many of them not only beating estimates, but blowing past estimates by as much as 10 and 20%. Then came Amazon's announcement on Thursday evening after the close. It took some steam, admittedly, out of the market. Amazon missed estimates, but more so they painted a dimmer view for second half sales growth. We don't feel this is a reflection on a strong consumer as much as it is the case of people simply getting out and about and doing more shopping live as opposed to online. That takes us to QQQ. We sold it into some strength early in the week. QQQ was on a 15% run since the middle of May. We wanted to take some of that off the table. We sold the position in US ETF, and we trimmed back by about 5% in tactical trend. It's nice to see small and mid get back into the game. They really faded over the past 8 weeks in comparison to large caps. As many of you know, small and mid really had a tremendous run from about October until the first part of May, and then they really plateaued, and we saw the bid come back into the market last week. So we feel that that's very healthy to have healthy breadth in the market. Internationally, developed countries led by Europe far outpaced emerging markets, which are dealing with a weakened China equities market. Matt will be back with us next week. Until then, have a great weekend.
Hi, I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors. Today is July 30th, 2021 in the afternoon. There was a lot of economic data that came out this week. In addition to that, there was more news on the virus variants and the increasing infections in the United States. There were corporate earnings for people to evaluate. And finally, China clamping down on some of its private companies, which really threw everyone for a loop. The economic data that came out was somewhat mixed. New home sales were down, durable goods orders were down, but estimates for GDP were up, consumer confidence was up. Initial jobless claims, the number that we always look at, was at 400,000. Expectations were for 385,000, so that was a little bit disappointing. We like to see it in the 300,000 level. In addition to all that news and that economic data, the Federal Open Market Committee met this week and announced that they were going to keep rates exactly the same, between 0 and 0.25%. They also didn't change any of their guidance. They still think that inflation is transitory, and as we've mentioned for a long time, the Fed does remain data dependent, and what information comes will affect their actions. And as we've also noted, that we do think that there's going to be mixed economic news going throughout the rest of the year, especially because of the pandemic reactions to it and increases in infections. The Treasury market, the 10-year ended the week at about a 123, down 5 basis points from where it was at the end of last week. And the 30-year ended down about 3 basis points over the whole time period to about a 189. Lower expected growth maybe from virus variations and strong demand for positive yielding assets from other governments also keeps our rates somewhat low. Municipal bond rates also were really flat for the week. The Muni 10-year ended at 0.82%, and the 30-year at a 1.39%. The Muni, they stayed flat. So the Treasury yields came down, Muni stayed flat. So the Muni Treasury ratio improved a little bit to 67% for the 10-year and 74% for the 30-year. These are pretty good levels, better than they were for investors a few months ago when demand was so strong and supply was low that the Muni Treasury ratio, it almost didn't even make sense to buy. You could buy a taxable Treasury and still get, the same taxable equivalent yield that you would have, or higher. So at any rate, there's plenty of investors chasing munis, even outside of the United States. International investors see them as a good ESG investment, especially now that we have taxable municipal bonds that Cumberland has used consistently in its taxable strategies. The supply is about $8 billion this week. $2.2 billion of that is taxable. So we expect munis to still do well going forward, which now leads me to the infrastructure bond plan. It seems that there is agreement in the Senate. They've got enough votes that this may in fact be passed. It's a $550 billion plan that kind of addresses roads, bridges, waterways, mass transit, airports, broadband, electric power grid resiliency. So that's good. On the maybe not so good for Muni Supply side is that tax-exempt advanced refunding bonds were not in the program. Not really sure why. It's just a big benefit to munis and doesn't seem to cost the government that much more. It's akin to where you would be able to refinance your mortgage at a lower rate. Why can't a municipal bond do that? If they're not allowed in the program, we'll have more taxable supply going forward because munis would still want to reduce their financing costs from deals that were done in higher interest rate times. Also, a Build America bond program may not be included, which is where a municipality can issue a taxable bond and get a subsidy from the federal government for the difference in price. So that may not be on there. That was very successful, a Build America bond type program, or was a successful program after the financial crisis. A lot of taxable municipal bonds were issued then and ended up being good for developing our infrastructure and helping munis out. Also, the private activity bond cap was increased, so that means some deals that would previously been considered taxable, private activity, now are eligible to issue tax-exempt bonds. All right, enough on that. So we'll see what happens. This has been elusive over the past 20 years that we were getting an infrastructure plan. Maybe we will, and so just have to wait and see. Next week, we will again be looking at initial jobless claims. We'll be looking at non-farm payrolls, which expect to be about 900,000 up. We'll be looking at the unemployment rate is expected to be down. It's estimated to come in at 5.7 compared to last month at 5.9. And importantly, the labor participation rate is expected to be a little higher than it was before, so labor force participation rates. So, and again, initial jobless claims, if I didn't just mention, is expected to be at about 380,000. So we'll see if it's in that 300 level. As always, wish you a happy, healthy weekend and look forward to seeing you again. Thank you.